You wake up in the morning. As you sip your coffee, you look around your home. You're in year 7 of a 20-year mortgage. You get into the car in your garage, a 5-year loan, 3 years still remaining. On your way to work, you hear on the radio, the economy is growing, consumer spending is up. When you return home in the evening, your credit card statement has arrived. You'll make the minimum payment this month too, because there's no other way. While you live this routine, somewhere else in the world, someone, a person you've never met, whose face you'll never see, is profiting from that minimum payment you just made. Not just from yours, but from millions of people's payments. And this system has been so perfectly designed that you see it as normal, even inevitable. This is the story of the modern age's greatest deception. Invisible, silent, and nearly perfect. Its name, the debt economy. Throughout human history, gold and silver have always been visible symbols of power. Kings displayed their treasuries, empires minted coins, conquerors sent ships laden with gold. But what truly enriched history's real masters wasn't gold itself. It was the promise of gold. It was bringing the future into the present. It was putting promises onto paper. In Mesopotamia, a farmer in a bad harvest year would borrow wheat from his neighbor, promising to pay back double the following year. Seems simple enough. But what happens if the second year's harvest is also poor? The farmer loses his land. If his land is gone, what then? He loses his freedom. He's forced to sell himself, his children. The Sumerians saw this, and they were horrified, because when too many people in a society became debt slaves, that society would collapse. Armies couldn't be raised. Fields couldn't be tilled. Revolts would break out. This is why Sumerian kings periodically held tablet-breaking ceremonies. The clay tablets on which debt records were written would be smashed, debts would be erased, society would be reset. This wasn't an act of mercy. It was a survival strategy. The Old Testament commanded a jubilee every 50 years. All debts would be forgiven, slaves would be freed, lands would return to their original owners. Its Hebrew name was Yovel, meaning ram's horn, because this year would be announced by blowing the horn. So where is this system today? The answer, it was destroyed. In 13th century Europe, charging interest was a sin. It was explicitly forbidden in the Holy Scriptures. The Catholic Church cursed usury. If a Christian charged interest to another Christian, they couldn't enter heaven. But rules never stopped the powerful. Jews were already barred from most professions. They couldn't own land, couldn't join guilds. One thing remained, lending money, because what was sin for Christians wasn't sin for Jews lending to Christians. A convenient theological loophole emerged. European kings needed money for their wars, their palaces, their mistresses. They borrowed from Jewish moneylenders. Then when debts became unbearable, they'd expel the Jews and confiscate their property. Debt forgiven through ethnic cleansing. This happened in England in 1290, in France in 1306, in Spain in 1492. But the system of lending didn't disappear. It evolved. Christian bankers found clever ways around the prohibition. They wouldn't call it interest. They'd call it partnership profits, or late payment penalties, or currency exchange fees. The Medici family in Florence built an empire not on armies or land, but on this disguised lending. They financed popes, kings, and merchants. And in return, they didn't just receive money, they received political power. A king in your debt is a king under your influence. By the Renaissance, something remarkable had happened. Debt had transformed from a shameful emergency measure into the foundation of commerce itself. Bills of exchange allowed merchants to trade across continents without carrying gold. A merchant in Venice could write a note promising payment in 3 months, and that note itself would circulate as money. Credit had become more valuable than coin. But the Real Revolution came in the 17th century. The Dutch Republic, fighting for independence from Spain, needed money for a war that seemed endless. Traditional methods, taxing citizens, seizing gold, had limits. So they invented something extraordinary. They would borrow from their own citizens by selling government bonds. Dutch citizens could buy these bonds, receive regular interest payments, and even sell the bonds to other investors. Suddenly, war was no longer limited by the gold in a treasury. It could be financed indefinitely by selling the future. Think about the genius of this for a moment. The government wasn't borrowing from foreign kings who might demand repayment during a crisis. They were borrowing from their own people, who had a vested interest in the government's survival. If the government fell, their bonds became worthless. The citizens became creditors of their own state. It was a form of financial patriotism. The Dutch perfected this model, and soon England copied it. The creation of the Bank of England in 1694 formalized national debt as a permanent institution. This wasn't a bank in the traditional sense. It was a mechanism for the government to borrow perpetually. The state would borrow from the bank, which would issue notes backed by those loans. For the first time in history, a government didn't just raise debt during emergencies. It lived on debt, rolling it over endlessly. And the bankers who managed this debt became indispensable to the crown. Debt had graduated from private contracts between individuals to the very foundation of state power. The profits were enormous. Lending to governments was among the safest bets in the financial world, because governments could raise taxes to pay their creditors. Wars that would have bankrupted kings could now be financed indefinitely. And those wars, in turn, expanded empires, opened new markets, and created more opportunities for debt. It was a perfect loop. The more nations fought, the more they borrowed. The more they borrowed, the richer their creditors became. By the 18th and 19th centuries, the bond markets in London, Paris, and Amsterdam were the beating heart of global finance. Armies marched, ships sailed, colonies were conquered, all on borrowed money. The Rothschild family became legendary for financing both sides of conflicts, ensuring profit regardless of outcome. Nathan Rothschild famously learned of Napoleon's defeat at Waterloo before the British government did, using that information to make a fortune on the bond market. Information plus credit equaled power. But this wasn't just about nations and wars. As industrial capitalism spread, ordinary people were drawn into the cycle. Railroads, factories, and infrastructure projects were built on credit, financed through bonds and bank loans. Workers earned wages from companies funded by debt, and then they themselves began to borrow, to buy homes, tools, and eventually consumer goods. Debt seeped into every layer of economic life. The 19th century saw the birth of something new, the mortgage. For centuries, land ownership had been the privilege of aristocracy. But as cities industrialized and populations grew, a new class emerged, the urban middle class. Banks realized they could lend money for home purchases, secured against the property itself. If the borrower defaulted, the bank simply took the house. It was low-risk lending that could be scaled infinitely. Suddenly, home ownership became possible for millions, but only by signing a contract that chained families to decades of payments. The psychological impact was profound. A mortgage wasn't just a financial obligation, it was a form of social control. A worker with a mortgage was a stable worker. They couldn't risk losing their job. They couldn't strike too aggressively. They couldn't move freely. They were tied to their payments, and therefore tied to the system. By the early 20th century, debt wasn't just a tool of governments or tycoons. It had become an everyday product sold to the masses. Installment plans for furniture, loans for automobiles, and eventually credit cards transformed debt into something normalized, even celebrated. The American dream itself became synonymous with debt. Own a home, own a car, send your kids to college, all purchased on promises to pay later. The genius, or the cruelty of the system, is that debt doesn't create profit just once. Every interest payment is a transfer of wealth from the debtor to the creditor, from the many to the few, repeated month after month, year after year. Unlike a product you buy once and consume, debt is designed to be permanent, to lock you into a cycle of payments that never truly ends. Consider the mathematics. A house bought with a 30-year mortgage at even a modest interest rate will cost 2 or 3 times its sticker price by the time it's paid off. A credit card balance rolled over month to month can grow faster than your ability to pay it down, especially if you're only making minimum payments. What began as a promise becomes a trap. The creditor profits from time itself, your time, your future labor, your children's inheritance. After World War II, this system went into overdrive. The Bretton Woods agreements of 1944, Celebrated as a new era of international cooperation, institutionalized debt as the foundation of the global financial order, the International Monetary Fund and the World Bank were created ostensibly to lend money to nations in crisis or development. But behind the lofty rhetoric was a simple mechanism: debt as discipline. Countries could borrow, but only on terms dictated by their creditors. The IMF, dominated by the United States and Europe, began attaching structural adjustment conditions to its loans. Borrow money, but you must cut education spending. Borrow money, but you must privatize your water system. Borrow money, but you must open your markets to foreign corporations. Entire national economies were told what to cut, what to sell, and how to restructure. Debt wasn't just profitable anymore. It had become a lever of political control. Nations that borrowed too much found their sovereignty compromised, their policies rewritten not in their own capitals but in Washington or Basel. The rhetoric was about stability and growth. The reality was dependency. A country perpetually servicing its debt is a country that cannot invest in its own future. It becomes an extraction zone for creditor nations. Meanwhile, a quieter revolution was happening in the daily lives of ordinary citizens in the developed world. Banks discovered they could sell debt not just to governments and corporations, but directly to households on an unprecedented scale. The mortgage became the crown jewel of middle-class aspiration. Owning a home, once reserved for elites, was suddenly possible for millions, but only by signing contracts that chained families to 30 years of payments. The psychological shift was massive. Debt was no longer shameful or rare. It became the normal way to participate in prosperity. Buy now, pay later became the mantra of consumer society. Enjoy life today and let the future take care of itself. The advertising industry sold this message relentlessly. You deserve it. You've earned it. Why would? For banks, this was a gold mine. Interest payments from millions of households produced steady, compounding profits with minimal risk. For governments, it created the illusion of endless growth, as consumer demand could be fueled by credit even when wages stagnated. For corporations, it guaranteed a steady stream of customers who could be enticed into spending money they hadn't yet earned. Debt became the hidden engine of modern capitalism. And unlike selling physical goods, selling credit was infinitely scalable. You didn't need to dig a mine or build a factory. You just needed signatures, contracts, and the legal authority to create money out of promises. A bank could create a loan with a few keystrokes, and that loan would generate interest income for decades. The danger, of course, was that the entire system became addicted to expansion. Banks didn't want debts to be repaid quickly. They wanted them rolled over, refinanced, extended. The longer people stayed indebted, the more profitable they became. Governments, too, learned that borrowing was easier than raising taxes or cutting spending. Politicians could promise benefits today and push the costs onto future generations who couldn't vote yet. By the 1970s and 1980s, the consequences of this addiction became impossible to ignore. Developing countries across Latin America, Africa, and Asia had borrowed heavily during the boom years of the 1960s and early 1970s, encouraged by Western banks flush with petrodollars after the oil shocks. Infrastructure projects, modernization programs, industrial development, all financed with loans denominated in dollars. Then, in the late 1970s, the U.S. Federal Reserve under Paul Volcker raised interest rates dramatically to combat inflation. Suddenly, these developing nations found their debt burdens exploding. The interest on dollar-denominated loans skyrocketed. At the same time, commodity prices collapsed, cutting their export revenues. They were trapped. The debt crisis exploded in 1982 when Mexico announced it could not service its obligations. Panic spread through the financial system. Would Mexico default? Would other countries follow? The solution imposed by the IMF and World Bank wasn't debt forgiveness. It was more loans, but with harsher conditions. Austerity programs were mandated: slash government spending, cut social services, privatize state industries, open markets to foreign competition. The human cost was staggering. In country after country, living standards collapsed. Unemployment soared. Inflation ravaged savings. Public hospitals and schools deteriorated. Entire generations saw their prospects destroyed. Yet through it all, the debt payments continued flowing northward to banks in New York, London, and Frankfurt. This was debt as a weapon of economic colonialism. Countries that had thrown off political colonization in the mid-20th century found themselves recolonized through financial obligations. They were sovereign in name, but their economic policies were dictated by distant creditors. The debt crisis of the 1980s revealed the true nature of the global financial system, a mechanism for extracting wealth from the periphery to the core, from the poor to the rich, all legitimized through the language of loans and contracts. Meanwhile, in the developed world, financial engineers were discovering new ways to package and sell debt itself. This was the era of securitization. Mortgages, car loans, credit card debts, student loans, all of these could be bundled together into securities and sold to investors around the world. A bank in California could originate a mortgage, immediately sell it to an investment bank in New York, which would package it with thousands of other mortgages into a bond, slice that bond into different risk tranches, and sell pieces to pension funds in Europe and Asia. Debt was no longer just a contract between borrower and lender. It had become a commodity in its own right, sliced, diced, repackaged, and traded globally. Wall Street transformed from a place that allocated capital to productive enterprises into a vast machinery for engineering debt instruments. The complexity became Byzantine. Collateralized debt obligations, credit default swaps, synthetic CDOs, financial products so complex that even the people creating them didn't fully understand the risks. The profits were astronomical. A bank could originate a loan, collect a fee, sell the loan to another institution, collect another fee, and move on to the next transaction. Risk was supposedly being distributed throughout the system, spread among many investors. In reality, it was just being hidden, obscured by layers of complexity, waiting for the inevitable moment when it would all unravel. That moment came in 2008. The subprime mortgage crisis began as a problem in one sector of the U.S. housing market, but it metastasized into a global financial catastrophe because debt had become so interconnected, so leveraged, so central to the entire system. When housing prices stopped rising and borrowers began defaulting, the whole architecture of securitized debt collapsed. Trillions of dollars in mortgage-backed securities, built on the premise that American homeowners could never default en masse, suddenly became toxic. Banks that had loaded their balance sheets with these securities faced insolvency. The shadow banking system, the network of investment banks, hedge funds, and other institutions that operated outside traditional regulation froze. Credit markets seized up. The global economy teetered on the edge of collapse. Governments around the world stepped in with unprecedented interventions. Central banks slashed interest rates to zero and injected trillions into the financial system through quantitative easing, essentially printing money to buy bonds. Governments bailed out banks, insurance companies, and even automobile manufacturers. The justification was that these institutions were too big to fail. Their collapse would bring down the entire economy. But notice who was saved and who was sacrificed. Banks received bailouts. Their executives kept their jobs and, in many cases, their bonuses. Meanwhile, millions of ordinary families lost their homes to foreclosure. Workers lost their jobs as businesses failed. Retirees saw their savings evaporate as stock markets crashed. Students graduated into an economy with no opportunities, burdened with loans they couldn't repay. The 2008 crisis should have been a reckoning. It should have prompted fundamental questions about whether an economy built on ever-expanding debt is sustainable or just. Instead, it became an opportunity for the debt system to entrench itself even further. The very institutions that caused the crisis were rescued and allowed to grow larger. The use of debt didn't shrink after 2008, it exploded. Central banks kept interest rates at zero for nearly a decade, encouraging everyone to borrow more. Governments ran massive deficits, adding to their already enormous debt burdens. Corporations took advantage of cheap credit not to invest in productive capacity, but to buy back their own stock, enriching shareholders and executives. Households, slowly recovering from the crisis, once again took on mortgages, car loans, and credit card debt. By 2020, global debt had reached levels never seen in human history. Over $300 trillion, more than 3 times the world's annual economic output. And then came the pandemic. Governments borrowed trillions more to support economies locked down to contain the virus. Central banks expanded their balance sheets to unprecedented levels. Debt piled upon debt. The irony is bitter. The crisis created by excessive debt was solved by creating even more debt. And the burden of this debt falls not on those who profit from it, but on ordinary people who will spend their lives servicing it through taxes, inflation, and diminished opportunities. Because here's what most people don't understand about how modern debt works. When a bank makes you a loan, it doesn't lend you money it already has. It creates new money through the act of lending. You sign a mortgage contract, and the bank credits your account with, say, $300,000. That money didn't exist before. The bank created it with a few keystrokes. But you have to earn that money through years of real labor. You have to work 40 hours a week, 50 weeks a year, for 30 years to pay it back with interest. The asymmetry is stunning. Money is created effortlessly as digital entries in a computer system, but it's repaid through actual human time, energy, and life. This is the alchemy of modern finance, transforming human futures into present profits for creditors. And it's all perfectly legal, perfectly normal, perfectly accepted. We're taught from childhood that this is just how things work. Want to go to college? Take out loans. Want to buy a house? Get a mortgage. Want to start a business? You'll need credit. Want to retire comfortably? Invest in bonds, which means lending money to governments and corporations so they can continue the cycle. The entire architecture of modern life has been constructed to normalize, even celebrate, debt. Financial literacy programs teach people how to manage debt, not how to avoid it. Credit scores measure your worthiness as a debtor, rewarding those who borrow and punish those who don't. The tax code incentivizes debt through mortgage interest deductions. Even the language has been sanitized. We don't talk about owing money, we talk about leveraging assets and accessing credit. Meanwhile, the concentration of wealth accelerates. Every interest payment, every debt service, represents a transfer from the many to the few. Over time, this funnels enormous sums upward, from millions of households to the balance sheets of major banks and institutional investors. Wealth doesn't trickle down in this system. It flows up, systematically and relentlessly. The most insidious aspect is how debt reshapes behavior and constrains freedom. A person burdened with debt is a person who must accept the terms offered by employers, who cannot take risks, who cannot protest too loudly, who must prioritize making payments above all else. Debt is a form of social control more effective than overt authoritarianism because it appears voluntary. No one forced you to sign that contract. You chose it. That the choice was between debt and exclusion from basic aspects of modern life, housing, education, transportation, is conveniently ignored. And now, as we move deeper into the 21st century, the debt system is evolving once again. Central banks around the world are developing digital currencies, money that exists only as code, fully traceable, fully controllable. Imagine a world where every transaction is monitored, where loans can be approved or denied by algorithms, where interest rates can be adjusted individually and automatically, where penalties can be enforced instantly without human intervention. To some, this sounds like efficiency. But if the history of debt teaches anything, it's that every increase in the power of creditors means a corresponding decrease in the freedom of debtors. Programmable money, combined with artificial intelligence and big data, could create a system of financial control more total than anything in history. Consider what's already happening. Your credit score is determined by opaque algorithms that factor in not just your payment history, but your shopping habits, your social media presence, even your friends' financial behavior. Insurance companies use similar data to adjust your premiums. Employers check your credit before hiring you. Landlords use it to decide whether to rent to you. A bad score, perhaps caused by a medical emergency or a period of unemployment, can trap you in a cycle of high-interest loans, poor housing, and limited opportunities. Now imagine this system on steroids, powered by AI, enforced through digital currency, operated by a partnership of governments and tech companies. A system where your money can be programmed to expire if you don't spend it fast enough, stimulating consumption. Where negative interest rates can be imposed automatically, punishing savers. Where certain purchases can be restricted or taxed differently based on your profile. Where dissent or undesirable behavior can be punished through financial exclusion. This isn't dystopian speculation. The technology exists. Pilot programs are running in multiple countries. The justifications are already being prepared: efficiency, security, preventing crime, ensuring stability. The same justifications that have accompanied every expansion of the debt-based financial system. So what's the way forward? For individuals, the answer begins with awareness. Recognize that you're not alone in struggling with debt. The struggle is designed into the system. The shame you might feel about financial difficulties isn't personal failure. It's a feature of a system that profits from keeping you indebted and anxious. Minimize your dependence on borrowed money wherever possible. This doesn't mean rejecting all debt. Some forms, like a reasonable mortgage, might be necessary, but approach it strategically, not as a lifestyle. Understand that every loan offer, every credit card solicitation, every low monthly payment advertisement is designed to extract wealth from your future. The financial industry spends billions on marketing to make debt seem attractive, normal, even sophisticated. Resist that programming. Build buffers, emergency funds, skills that can't be automated, communities of mutual aid. The more financially resilient you are, the less power the debt system has over you. This is difficult when wages are stagnant and costs are rising, but it's also essential. Every dollar you don't owe is a small declaration of independence. Politically, demand change. The debt jubilees of ancient times weren't charity. They were structural necessities to prevent social collapse. Modern debt burdens, especially student loans and medical debt, serve no productive purpose. They don't build infrastructure or create prosperity. They simply transfer wealth upward and constrain an entire generation. These debts should be forgiven, not as a favor, but as a correction of an unjust system. Challenge the narrative that government debt is inherently bad while private debt is fine. Government debt, at least theoretically, can be used for public benefit, infrastructure, education, healthcare. Private debt exists to generate profit for lenders. Yet we're constantly told that government deficits are crises while household and corporate debt are normal. This is backwards. A government that issues its own currency can never truly run out of money in the way a household can. But we're taught to think of national budgets like household budgets, which obscures how the system actually works and who it serves. Support alternatives. Credit unions instead of major banks. Local currencies and time banks. Cooperative ownership structures. These aren't panaceas, but they represent different models, ways of organizing economic life that don't centralize power in the hands of creditors. The more diverse and resilient our economic ecosystems, the less vulnerable we are to the failures and predations of the dominant system. Most fundamentally, reject the idea that this is all inevitable or natural. The debt-based financial system isn't a law of nature. It's a human creation, built over centuries through deliberate choices by people who profited from those choices. It can be changed. Other systems are possible. History shows us that financial systems that become too extractive, too disconnected from productive activity, eventually collapse. The question is whether that collapse will be chaotic and devastating, or whether it can be managed and transformed into something more equitable. The debt burdens hanging over households, corporations, and governments today are mathematically unpayable. The system survives only through various forms of extend and pretend, low interest rates, asset bubbles, inflation that slowly erodes the real value of debt. But this can't continue indefinitely. Eventually, something breaks. The hope is that when it does, we'll have the wisdom and courage to build something different rather than simply recreating the same system with new labels. The story of debt is ultimately the story of power, who has it, how it's maintained, and how ordinary people are kept from recognizing their own exploitation. Debt is invisible chains, consensual only in the sense that drowning people consent to grab whatever's thrown to them. The genius of the system is making the chains seem like opportunities. the exploitations seem like empowerment. But once you see it, you can't unsee it. Every payment, every interest charge, every monthly statement is a reminder that your time and labor are being converted into someone else's wealth. The question then becomes, what will you do with that knowledge? How will you live differently? What will you teach your children? How will you resist, even in small ways, a system designed to keep you forever indebted? These aren't easy questions, and there are no simple answers. But they're the questions we must ask if we want to be anything more than economic units in a machine designed to concentrate wealth and power. The most profitable product in history thrives on our ignorance, our resignation, our belief that there's no alternative. There is always an alternative. The first step is refusing to believe the story they've told us about how the world must work. The second step is imagining something different. The third step is building it, however slowly, however imperfectly, in whatever spaces of freedom we can create or defend. Because in the end, that isn't really about money. It's about time, your life, your freedom to choose what you do with your precious, finite existence. And that's something worth fighting for.